All right, let's dive straight into this explainer. Think of this not just as your standard review, but as an absolute A-star masterclass. Today, we're tackling one of the most critical topics in your entire syllabus, inventory valuation, and specifically the epic clash between cost and net realizable value. Now, throughout this session, I'm going to be swapping between two very distinct hats to guide you. First, the subject specialist hat, where we'll decode the complex technical concepts, build up your foundational understanding, and nail down those practical methodologies. And second, the senior examiner hat, mapping out the exact exam strategy, the common pitfalls, and the insider insights you need to completely conquer IGCSE Accounting 0452. Let's get right into it.
Here's our roadmap for today. 1. The A-star conceptual blueprint. 2. Technical execution and method marks. 3. Assessment Objective 3, focusing on ratios and evaluation. 4. Modern fintech and real-world apps. 5. Examiner warnings and pitfalls. And 6. The final A-star challenge.
So kicking things off with Section 1, the A-star conceptual blueprint and our 2028 to 2030 syllabus foundations.
Okay, putting on the senior examiner hat for a second, I really need to stress something here. The updated 2028 to 2030 syllabus demands absolute, 100% accuracy with modern international terminology. If you're chasing that A-star, you have got to completely ditch any outdated terms. You need to be consistently using irrecoverable debts instead of bad debts, and owner's equity instead of just capital. Why? Well, think about it. Bad is just an opinion, but irrecoverable is a confirmed financial fact. Using these exact terms signals immediately to the examiner that you fully grasp the modern business entity concept and you're perfectly aligned with current international reporting standards.
Switching back to the subject specialist, let's look at the absolute golden rule of inventory. Inventory is always valued at the lower of cost and net realizable value, or NRV for short. Now, this creates a massive tension right at the heart of inventory valuation. It's the historical cost principle versus the prudence concept, a classic accounting tug-of-war. Imagine you bought 100 smartphones last year for $500 each. That's your historical cost. But suddenly, a brand new model drops, and now you can only sell your older inventory for $300 a pop. That $300 is your net realizable value. The prudence concept literally forces you to value them at that $300 mark. Sticking rigidly to historical cost would artificially inflate your profits because you're ignoring a very real drop in value. Recognizing that $200 per unit loss immediately, that is exactly what separates a good student from an A-star accountant. Remember, prudence dictates we never anticipate a profit, but we always account for a probable loss.
Moving right along to Section 2, Technical Execution and Securing Your Grade.
So we know the concepts, but how do we actually execute the advanced technical methodology when you're sweating it out in the exam hall or grinding through a coursework project? Well, it's a flow. You start with a business document, move to the books of prime entry, draft your T accounts, extract a trial balance, and finally, produce those financial statements. In your coursework and practicals, your ability to document evidence starts right at step 1. Never post a transaction without explicitly tying it back to the source invoice or receipt. That paper trail is your procedural logic. And here is a massive golden rule for your written exams. Even if your final math is completely wrong, following this exact logical step-by-step procedural flow ensures you secure those crucial method marks. Always show your workings and track that flow of evidence.
But hey, we obviously want to avoid getting the math wrong in the first place, right? You absolutely must clearly distinguish your discount calculations because confusing them is a huge pitfall. A trade discount is deducted before it ever even sniffs the ledger. Imagine a $100 item with a 10% trade discount. Your prime entry is just straight up $90. A cash discount, on the other hand, happens way later down the line in the cash book, strictly when the customer actually pays early. Mixing these percentages up, like calculating a cash discount on the list price instead of the invoice price, will completely torpedo your chance at a 100% perfect trial balance.
All right, Section 3, Assessment Objective 3, which is all about interpretation, ratios, and evaluation. Picture this. You're looking at a current ratio, and it plummets from a very healthy 2.5 to 1 all the way down to a terrifying 1.1 to 1. Now, a healthy 2.5 to 1 means you've got $2.50 in liquid assets for every single dollar of short-term debt. Plunging to 1.1 to 1 means you are teetering dangerously on the edge of not being able to pay your bills. But here's the thing. Calculating that drop is just a baseline skill. Anyone can plug numbers into a calculator. To get the A-star, you have got to evaluate the why.
You need to put on your financial detective hat and ask these high-level analytical questions. Has inventory been overpurchased and is just sitting there gathering dust, tying up all your cash? Are trade payables being settled way too slowly, totally wrecking vital supplier relationships? Or were cash reserves suddenly wiped out by some massive capital expenditure like buying brand new machinery? This is exactly what the examiner means by Assessment Objective 3, Investigative Skills. You're not just a calculator, you're an analyst. Answering these questions is how you interpret what the math actually means for the survival of the business.
And here's a massive analytical trap you really need to watch out for. Interfirm comparison becomes an absolute nightmare when businesses are using different accounting policies. Like, if you try to compare a firm using the straight line method of depreciation, where the expense is just a flat line every year, with a firm using the reducing balance method, which heavily front-loads the expense in the early years. Direct comparisons of their profit margins are basically impossible because the foundations of their asset valuations are fundamentally different. You must always highlight these policy differences in your evaluation before declaring one business as more successful than another.
Furthermore, we can't just stare at the numbers. To truly lock in those top evaluation marks, you have to recognize vital non-financial factors. Things like staff morale, the physical location of the business, its overarching market reputation. These non-financial elements dictate a business's long-term sustainability and their true return on capital employed. But here is the insider secret. They are completely invisible in standard accounting records. You are never going to find staff morale listed on a balance sheet. A true A-star accountant always discusses the invisible factors right alongside the visible math.
Next up, Section 4, Modern FinTech and Real-World Apps, looking at the core architecture.
Let's step out of the classroom for a second to satisfy our research mandate. Let's look at how modern fintech and AI-driven accounting software handle these exact concepts. You might think, oh, software does it all differently now. But actually, even the most bleeding-edge AI accounting platforms like Xero rely strictly on the exact same T-account structures and the fundamental accounting equation we're studying right now. Assets equals liabilities plus equity. That logic is hard-coded into the AI's database to ensure 100% accurate duality. The AI doesn't invent new rules. It just rigorously enforces the 2028 to 2030 syllabus standards at lightning speed. Maintaining the integrity of financial records for banks and tax authorities relies entirely on the basic logic you are mastering today.
Which brings us to Section 5, Advanced Examiner Warnings and Pitfalls.
Putting the senior examiner hat firmly back on, we need to look at the latest principal examiner insights. Please do not throw away easy marks. If the examiner literally cannot read your ledger entries because your handwriting is too messy, or if you carelessly misclassify a long-term capital expense, like buying a delivery van, as a short-term revenue expense, like paying for the van's gas, your perfect logical flow is totally ruined. Your procedural knowledge means absolutely zero if the examiner can't confidently decipher what you've actually written on the page.
And let's quickly talk about balancing techniques. Here is a literal A-star memory hack for when the exam pressure hits. Balance C/D means you are closing down the account for the current period, and balance B/D means you are beginning the day for the new period. Always double-check your state symbols in manufacturing accounts and ruthlessly enforce this clear distinction between brought down and carried down balances. It's such a simple way to avoid bleeding method marks.
And finally, Section 6, the final A-star challenge. It's time to pause and think. We've built a conceptual blueprint, we've navigated the technical pitfalls, and now with my subject specialist hat back on, I challenge you to apply the advanced technical methodology. I want you to literally pause this explainer right now and answer this cause-effect chain question. How exactly does ignoring a drop in net realizable value violate the prudence concept? And more importantly, how does this sequentially mislead vital stakeholders, like banks and tax authorities, who rely on your numbers for loans and compliance? Map out that exact chain reaction in your notes, step by step, because mastering that level of deep investigative evaluation, that is exactly what transforms a good student into an A-star accountant. Good luck with the challenge, and keep building those A-star habits.